Good morning, everyone. Welcome to this KPMG webinar on IFRS compared to Dutch GAAP. It is our aim to update you frequently on IFRS developments and our publications. And this webinar is part of that series. Already almost 70 viewers have logged in, and we hope to be with around 200 attendants today. So we are very pleased that so many of you have taken the time to listen. And thank you for joining us. As we have recently published our new publication on the main differences between IFRS and Dutch GAAP, we are pleased to discuss a number of the main topics and differences with you. This presentation will last an hour, and surely this time frame restricts us in discussing all differences. However, you will have the opportunity to ask questions through the private chat function. We may not be able to answer them all, but we try to cover them as many as possible. My name is Fred Versteeg, and I'm partner in the Department of Professional Practice within KPMG here in the Netherlands. And amongst others, I'm responsible for the accounting positions taken here within this firm. I will be presenting this webinar together with Laurens de Waal. He is director in the Capital Markets Accounting Advisory Services Group. He is primarily engaged in large engagements such as IFRS conversions. But you will listen to me first, and Laurens will take over later on. As said, we will discuss a number of main accounting topics and differences based on our recently published new edition of differences between IFRS and Dutch GAAP. I also like to refer to our publication Dutch GAAP compared to US GAAP. The most recent version of that publication dates from September 2017, and we will plan to update this shortly. So that will come to you as well later this year. Why this webinar? Well, as said, we have spent a significant amount of time in the preparation of the new publication of the new edition of our publication on IFRS compared to Dutch GAAP. We believe that this is time well spent, as insights into differences between IFRS is important. Most of you will know that IFRS is part of Dutch law. The Dutch Civil Code allows to use IFRS as an accounting standard for the preparation of the financial statements in the Dutch environment. But we should also see a continuing increase of IFRS reporters. IFRS is definitely not restricted to listed companies anymore. We also have seen an increase of differences between IFRS and Dutch GAAP, and I will talk about that a bit later in this presentation. Furthermore, our clients and relations tell us that they want additional insights into IFRS, especially those that are thinking of converting to IFRS in the short future. And stakeholders such as bank and investors increasingly ask for financial reporting under IFRS. We see that governance for loan arrangements are based on IFRS. And even if alternative performance measures are being used, IFRS is still used as a starting point. So our observation is that it is increasingly becoming the world financial report language. This is the agenda for today. So the next hour will cover a number of items. I will start discussing a bit on the framework of IFRS and Dutch GAAP and also on the development over the years. We will touch on financial statement combinations in the Dutch practice. Obviously, because we refer to our publication, but therefore we also discuss a bit on differences we see in practice. We'll cover a bit on latest IFRS and Dutch GAAP treatments and developments. And we'll close our presentation with some information on GAAP conversion projects. But before we move on with the topics on the agenda, we have two questions that we would like to ask you and that we will put on the screen. So you can use the interface just answering the question I will just put up on the screen. And I will do that in a minute. You will find a question which we would like to know from you is basically how many times, how often have you been involved in a GAAP conversion? And I see answers coming in. I will leave it a few seconds open just for you, just to give you some time to answer the question. Okay. I think I will close the polling now. So, and I would like to ask another question, and I will put that up as well. The next question I would like to raise is, do you plan to be involved in a conversion this year? And this is basically a simple answer, yes or no. Okay, the answers keep coming in still. I'll just wait for another few seconds. Okay, thank you for that. So what we can see from these two questions is that quite a few number of participants have been or will be involved in a GAAP conversion. So we believe that it's therefore even more important to discussing the main topics, the main accounting topics today, and also the differences between Dutch GAAP and IFRS. So let's move to our next slide, which is on the framework. In our publication and in our presentation today, we are comparing two accounting frameworks. It is needless to state that these frameworks have been established over quite some years now and consist of various sources of authoritative guidance. And on the IFRS, that's obviously the framework as a starting point, but IFRS furthermore includes the IFRSs and the IASs. The latter are the standards that have been developed by the predecessor of the IASB. And these older standards cover topics such as IS1 on the presentation of financial statements, IS2 inventories, IS16 property, plant and equipment, and those types of standards, the older standards I would like to call them. But obviously the IASs have exactly the same authorities as the new standards IFRSs. The standards are regularly updated. Also, an annual improvement program from the IASB is applicable, and you will see come out every year. Completely new IFRS standards are not issued often, but when it's done, it normally has a big impact. And recent examples are, of course, IFRS 9 on financial instruments, IFRS 15 on revenue recognition, and very recently, or that will be applicable for this year, is IFRS 16 on leases. What we see on the Dutch GAAP is that, the DASB, the Dutch Accounting Standards Board, or the Raad van de Jaarverslaggeving, as you would like to call it, they basically provide annual updates with small changes to various standards. And nowadays, we do not see many major overhauls on standards. An entity claiming compliance with IFRS must comply with all the standards and interpretations, including disclosure requirements, obviously. The same is applicable for Dutch GAAP. However, the one important item to remember is that we must be aware that the Dutch Accounting Standards Board, or RJ, or Raad voor de Jaarverslaggeving, is a private organization that provides explanation of the generic requirements in Dutch law. So it's not Dutch law in itself, but it's basically an explanation of the generic requirements. And finally, perhaps it's also good to mention that the IASB has also developed IFRS for SMEs. The requirement on the IFRS for SMEs are less extensive, but this set is not part of Dutch law, so it's not being embedded in Dutch law. But if you then look at the Dutch GAAP and the Dutch accounting standards, the DASB has also has published a set of guidelines for small and micro companies, again as explanation of Dutch law. Let's look at the development, and I'm basically trying, with this picture, I'm trying to compare whether IFRS and Dutch GAAP have closed the gap over the last couple of years. And what you see is that with this slide, you will actually see is that IFRS and Dutch GAAP and the differences have evolved over the years. You will see the gap almost closing, but also widening again. As already mentioned, IFRS can be voluntarily applied by legal entities under Dutch law. And the application is mandatory for listed entities since 2005 in the EU. And then over the years, what we have seen is that the DASB harmonized new standards with the requirements from the IFRS equivalents. But what we saw is that departure started again with the adoption of IAS 19, employee benefits, and continued with the new standards of consolidation, IFRS 10 and IFRS 11. These new standards in IFRS have not been taken over by the Dutch Accounting Standards Board. If you now look at the new accounting standards, such as IFRS 9 and IFRS 15, but also 16, these new standards differ significantly from the Dutch GAAP equivalents. However, Dutch GAAP allows application of these new standards or parts of these new standards when reporting on the Dutch GAAP. For us, it seems a bit like picking and choosing of the application of IFRS standards on the Dutch GAAP. And the Dutch GAAP even have been a bit criticized for not having a clear view on the application of IFRS as part of Dutch GAAP. And we now see also comment letters pouring into the Dutch Accounting Standards Board, and they currently are working on a very strategic or basic question: what are we going to do in future with IFRS and the application of IFRS in the Dutch accounting standards? Furthermore, where Dutch GAAP includes size criteria and various reporting exemptions for small and medium-sized entities, IFRS includes requirements that apply to all adopters. Again, an exception is IFRS for SMEs, but that's not an allowed standard, which I already mentioned before. On this slide, you will see, which at first sight it seems a very complicated slide, but this slide will shows you the various options under Dutch law and what you can apply in the financial statements. So it's basically various options, and I'd like to talk a bit about those options, and it refers to both the consolidated financial statements and the company-only financial statements. And as you will see on the slide, we have 6 options. I'm not going to cover them extensively, but basically what you see on the option 1 is that you basically apply Dutch GAAP in both the consolidated and the company financial statements, which has been applicable for a number of years already, obviously, and still is applicable. Under option 2, what we there see is that you will apply IFRS in the consolidated financial statement and Dutch GAAP in these company financial statements. So there will be differences between the consolidated and the separate financial statements, and also there may be therefore automatically differences in equity and profit and loss between those two. A typical Dutch option, which is the option 3, is the IFRS being used in the consolidated financial statements, but in the separate financial statements of company-only financial statements, the application of Dutch GAAP, however, using the measurement principles. And I see now a question already coming in and asks which combination is most commonly used. Now, actually, this is the one that is most commonly used. So option 3 is, I think, 95% of all reporters that at least report in the consolidated financial statements under IFRS also apply the combination 3. And trying at least to minimize the differences between equity and profit and loss by using that combination, that option. Option 4 is basically using IFRS in both consolidated and separate financial statements. Must be aware, though, that a number of additional Dutch GAAP requirements, legal requirements apply, such as disclosure of number of full-time equivalents, director's remuneration, audit fees, those types of things. So you're not fully off the hook from Dutch GAAP if you apply IFRS. And then just to make, the options to make it complete, if you only have just one single set of financial statements, then you can apply Dutch GAAP or IFRS. So I think this is basically it as a kind of generic way of looking at what the accounting framework is and what options can be applied. I think it's now time to dive a little bit deeper in the differences. And with this, I would like to hand over to Laurens, who will talk about those differences that we see in practice.
Okay, thanks, Fred, for your introduction, explaining IFRS, Dutch GAAP differences, and our publication, actually our third publication. And in the publication, there are numerous topics to discuss. We're not going to all discuss those topics in this webinar. Some are quite specific, like biological assets, which not for a lot of companies is applicable. So we made a decision to select some topics. I think first it's good to discuss a bit about first-time adoption of IFRS. That's a specific standard in IFRS called IFRS 1. And that's only relevant when converting to IFRS. Once you are at IFRS reporting, then this standard is no longer applicable. Secondly, it's also good, although Fred did talk a bit about it on IFRS, is the formal components of financial statements and the differences between Dutch GAAP and IFRS, a bit more in detail. And then we top on some topics: consolidation, business combinations, intangibles, joint arrangements, employee benefits, which could be quite complex under IFRS, especially pensions, and also talk a bit about the latest accounting standards, 9, 15, 16, difference between Dutch GAAP, IFRS, and some DASB announcements made, how to incorporate that in Dutch GAAP, those IFRS standards. Let's go to the next slide. So, first-time adoption of IFRS. As said, IFRS 1 first-time adoption is a specific standard in IFRS and has several optional and mandatory exemptions on how to convert to IFRS. Those exemptions, are very helpful. And those are included because the ISB intention is to make the companies as easy as possible to convert to IFRS without a fully retrospectively application of all IFRSs. So in practice, we hear a lot of things, IFRS is complex, they have a lot of rules, regulations, but this is really a standard which helps you, to convert to IFRS on a smooth way. So when you convert to IFRS, like I said, the first time adoption, if you convert to IFRS as per 31st December 2019, as an example, then the date of transition is actually the beginning of the previous comparable period with the comparable period of 2018. So the date of transition is 1st January 2018. That's the starting date when you have to convert your, in this case, Dutch GAAP to IFRS. So in the publication, we did not include a comparison between IFRS and Dutch GAAP on that first-time adoption, as Dutch GAAP has no specific standards for first-time adoption and all the transitional guidance and exemptions. So when converting from IFRS to Dutch GAAP, what we do not see a lot in practice, to be honest, but you never know what could be happen. You should have done that fully retrospectively following the guidance of REA, the DAS 140 change of accounting policies. So you have to go back in time. But also one of the benefits of IFRS 1 is that acquisitions before the date of transactions are not remeasured, and the related book values as measured and recognized under Dutch GAAP will not change. So when you have determined the acquisition, the Goodwill, and the Goodwill is amortized, you just convert the same amount of Goodwill in your IFRS books and then start a different accounting policy for goodwill, and that's impairment testing rather than amortizing. Another example of IFRS 1 exemption is also that you can apply the deemed cost approach for plant, property, and equipment, whereas the fair value could be the deemed cost. So you can increase the value of the PP&E and equity. However, you should note that Dutch law may require that you have to account for reevaluation reserve in this case, as fair value exceeds historical cost. So in this way, you can see that Dutch law is also relevant and important still when you are applying IFRS. Go to the next slide, formal components of financial statements. So if you look at the slide, you see it's in Dutch. Most audience are Dutch speaking and understanding, so that's helpful, I think. You see this is a copy from the besluitmodellen jaarrekening, the annual accounts degree format, and it's an P&L, profit and loss account, by nature or by category. Unlike Dutch GAAP, IFRS has not defined a prescribed format for balance sheet and income statement, although IFRS 1 requires certain minimum balance sheet and income statement captions to be included in these primary statements. So according to the Dutch Civil Code, or the Netherlands Civil Code nowadays, besluitmodellen jaarrekening, large entities should choose between one of the prescribed formats. So, for example, in this case, the income statements, there are two models available, and it differs in presentation by either by function or by category by nature. Note that we do see in practice that both under IFRS and Dutch GAAP companies apply sometimes mixed models. For example, using cost of goods sold, which is a by function model, they include it in a by nature model. Not always, if you look really at the figures of what's meant by cost of goods sold, sometimes employee expenses are included, sometimes excluded. So it's not always that it's wrong accounting or wrong presentation, but it's you better change then the name of raw materials and consumption rather than cost of goods sold. We see it a lot of practice that the presentation sometimes fails. In addition to that, one of the ISB current projects is regarding primary financial statements. So after 15, 16, and 17, there's a new project going on. This project is an early stage, although, and the ISB is doing a research, examine possible changes in the structure and content of those primary financial statements. And we will come back on that later. It's more the presentation of the P&L and alternative performance measurements. So going to consolidation, one of the topics which is included in our publication. And initially, the Netherlands Civil Code determines whether a company should prepare consolidated financial statements, regardless if the company or group is applying either IFRS or Dutch GAAP. Let's say you are under IFRS, then IFRS 10, which was introduced in 2013. Consolidation is based on a power direct model. It's quite a complex standard, and in general, definition is an investor controls an investee if it is exposed to or has the right to variable returns from involvement with the investee and has the ability to affect those returns through its power over the investee. So unlike IFRS, consolidation of the Dutch GAAP is more focused on the primary concept of the group company rather than on the control element. The main criteria for group companies, Dutch GAAP, is economic unit, organizational connection, central management. So although these are different concepts, to be honest, in practice, we do not see many differences where you should consolidate under the GAAP, Dutch GAAP, and not consolidate under IFRS. So two concepts, but in practice, there are not a lot of differences. Unlike IFRS, Dutch GAAP has some exemption for consolidation. As you might know, there is an exemption, so-called Article 407, for small groups. If you're a small group, you do not have to consolidate. Of course, you can consolidate, but it's not mandatory. And so also the Article 403, which then the company do not prepare and publish financial statements because the parent company made a guarantee and published their financial statement at the Chamber of Commerce. Although there are some conditions when applying 403, which the parent company normally have to draft their financial statements, based on regulations in the EU. The other one, a lot used in the Netherlands, is the so-called 408 exemption, and that's available for non-listed intermediate holding companies. So they prepare only single financial statements, as the numbers are consolidated at a higher level in the parent company. The 408 is also available in IFRS 10, so-called IFRS 10.4a, is also an intermediate holding company exemption available. Now we move on to the next slide, and that's business combination. And Fred will continue this presentation with you.
Yeah, business combinations. What you will find in this slide is a big box, a big purple box. And I think this is all what the business combination standard, IFRS 3 and the Dutch accounting standards 216 are all about, is really trying to figure out what you have purchased and trying to, the both standards will give you guidance on how to take out the various bits and pieces that are part of that big box. So IFRS 3 and the Dutch accounting standards 216 are very different from the other standards. In contrast to the other standards, IFRS 3 and 216 are very much focused on that question. How do the acquired big box needs to be recognized in the financial statements? It's not the big box in itself, because that's a subsidiary, and that's more in the separate financial statements normally. But this is really about the consolidated financial statement and all the items that should go in there for the first time. So firstly, you will need to determine, amongst others, whether the box in fact contains a business. Is it a business combination? And whether you are the one who actually have bought it. So who's the acquirer in that instance? And then finally, during the PPA process, you then need to identify the various components that are included in the box and therefore are also part of the acquisition accounting. Now, if you look at differences between IFRS and Dutch GAAP, you will find that business combinations are accounted under IFRS automatically under the acquisition method. Only very limited exceptions, but basically you apply the acquisition method. Contingent considerations, if any, are measured at fair value. And subsequent changes are recognized in profit and loss. So that's a one-time recognition at fair value through the goodwill, but then subsequent changes cannot be adjusted in goodwill anymore. The identifiable assets and liabilities assumed are recognized separately from the goodwill, obviously. The negative goodwill, if any, is recognized in profit and loss after reassessing the values used in the acquisition accounting. And common control transactions are not explicitly covered in any of the standards and also not in IFRS 3. If we then look at Dutch GAAP, then in contrast to the mandatory acquisition method under IFRS, in some cases, pooling of interest method can still be applied. You need to meet certain criteria, but still there is some more lenience towards another accounting method than under IFRS. If we look at contingent consideration, that's recognized as soon as the payment becomes probable and the amount can be measured reliably. And also subsequent changes in contingent considerations will change the goodwill. So these are included in goodwill. This is obviously in contrast to IFRS. Looking at the identifiable assets and liabilities, these are also separately recognized. However, especially intangible assets are recognized only if they meet the more strict recognition requirements under Dutch GAAP. Negative goodwill is recognized as a liability, so not immediately in profit and loss, but is recognized as a liability on the balance sheet and is released in profit and loss when certain criteria have met, etc. But basically not recorded in profit and loss at day one or at initial recognition. And then looking at common control transactions, these are specifically covered. The acquirer applies acquisition accounting or book value accounting in common control transactions, but this has been now guidance over the last couple of years in the Dutch accounting standard. So that's very helpful, at least for in the application of Dutch GAAP, I would say. By the way, I've not seen many questions coming in recently, so if you do have questions, please do not hesitate to send them in. It is a private chat, so no one will see your question, only us. But please feel free to do so if you have any questions. Moving onwards towards our fifth topic, which is about intangibles and goodwill. And yeah, I would say this relates very much to the topic I just discussed on business combination. It focuses really on the main differences between intangible assets and goodwill. I'd like to start with the intangible assets. Well, the general recognition and measurement requirements for intangible assets are generally the same under IFRS and Dutch GAAP. However, looking back to a business combination, the recognition criteria for Dutch GAAP for intangibles acquired in a business combination are stricter than IFRS, simply because the DASB requires to apply the general recognition criteria, whereas IFRS requires to recognize intangible assets just if you know that these are separable. So this is basically the only requirement. You need to establish whether intangible assets are separable. But for instance, the probability threshold for economic benefits is not a separate criterion under IFRS. Instead, the probability threshold, it's simply a part of the fair value measurement. So you simply take into account the probability that you will generate benefits. And if it's only a 10% chance that you will be able to generate benefits, it still has a certain value. Furthermore, under IFRS, the reliability measurement or the reliable measurement criterion is always to consider to be satisfied for intangible assets acquired in a business combination. So you need to come up with a measurement one way or the other. That's the main take I would like to give you. And then after the purchase price allocation from a business combination, and after that has been performed, the resulting goodwill amount on the IFRS therefore will normally differ from Dutch GAAP because of the different requirements for the purchase price allocation. And then we had that number, we have that different number on the Dutch GAAP compared to IFRS, and still other differences apply. So, for instance, the resulting goodwill, as well as certain intangible assets with a so-called indefinite life, will not be systematically amortized, but must be tested for impairment annually. On the Dutch GAAP, goodwill intangible assets will need to be amortized over its useful life. And by the way, this is assumed not to exceed 20 years. Well, we have received a question on the common control transactions under IFRS. I just referred on the topic of business combinations to the fact that Dutch GAAP has some requirements on common control transactions, basically implicitly saying that IFRS does not have those requirements. I think in general, we would say that the Dutch requirements or guidance on possibilities on common control transactions are more or less also applicable under IFRS. For instance, I would like to refer to our own insights into IFRS, which is our own publication on IFRS guidance, where we have a specific topic, a specific chapter chapter only in relation to common control transaction, basically also explaining that you can apply acquisition accounting, pooling of interest type of approach, or carryover type of approach. There are certain conditions that may apply, but generically speaking, I would say that the guidance on the Dutch GAAP would be similar as we would, let's put it this way, that what we would apply on the IFRS would be similar to the guidance we have now available on the Dutch GAAP. So I hope that sufficiently answers the question you have. Another interesting topic, which sometimes I see really happening. I see people asking whether this, in fact, is a difference between Dutch GAAP and IFRS, and the answer very simply is yes. It's a huge difference, and this is about joint arrangements. We've tried to visualize in this slide by showing a 50-50% share of the ventures A and B in the joint arrangement C. But please be advised that a joint arrangement means that parties need to be bound by a contractual arrangement that give two or more parties joint control. So it's not simply just the percentage, the 50% percentage that is driving or is part of the definition of a joint arrangement. It is really about a contractual arrangement that gives you joint control. The assessment whether a contractual arrangement is a joint arrangement requires much judgment and assessment of, amongst other things, substantive and protective rights. And for me, I always would look at the way dispute resolution is organized, because that may be very helpful in assessing whether a contract is in fact a joint arrangement. But okay, having established that we have a joint arrangement, we have another question to ask, and that's whether the joint arrangement is either a joint operation or a joint venture. And this is not simply an accounting policy choice. This is an assessment based on the legal and economic facts and circumstances. And obviously, without going into full detail, because otherwise we would be spending another few hours, a joint operation is a joint arrangement whereby the parties that have joint control to the arrangement have rights to the assets and obligations for the liabilities. So it's really direct link to the assets and obligations within the joint arrangement itself. And a joint operator, therefore, also recognizes its interest in those assets and liabilities. It seems a little bit like proportionate consolidation on the Dutch GAAP, but you basically show your part of the assets and liabilities. However, a joint venture is a joint arrangement whereby the parties have joint control over the arrangement and have right to the net assets. And I emphasize net assets. So it's not really the individual assets and liabilities, but basically normally your share in the equity of a Dutch BV or a Dutch NV. And that those entities used in a joint arrangement will typically be a joint venture. And be aware that investments in joint ventures, those shall be accounted for using the equity method. Therefore, the accounting for joint operations in joint ventures is not an accounting policy choice. And I think this is the big difference with Dutch GAAP, because if you would look at Dutch GAAP, well, first of all, joint arrangements are not really specifically being defined. It normally uses the term joint venture. But having said that, investments in joint ventures, such as BVs or NVs, will be measured either at net asset value or using the proportionate consolidation method. Well, the latter method can only be applied if legally required, if it's legally required for an understanding of the financial performance. But we believe that in practice, this requirement is normally easily met. And therefore, you have a choice between the accounting for at net asset value or proportionate consolidation, which is a huge contrast to IFRS. And to finalize, this is an accounting policy choice for every joint arrangement. So you cannot pick and choose which joint arrangement you would treat the one way or the other way. Looking at the questions, I received another question, which is basically on the previous slide, where we discussed Dutch GAAP Goodwill. And Dutch GAAP Goodwill is amortized. Yes, because I've said that it needs to be amortized over the useful life, which is presumed to be a maximum of 20 years. And the question is whether a company can amortize it in the first year. So a one-off amortization, basically. Now, it depends on the facts and circumstances. That's always a good answer, I would say. But obviously, you need to make an assessment of the useful life. So, and that may be 1 year, that may be 5 years, maybe 10 years, but you need to make an assessment and you need to document that. And there may be also changes in future. So every year you need to see whether that assessment needs to be re-evaluated and may lead to a different amortization period. So I hope that I have covered that one as well. Well, I think enough on joint arrangements for now. I think I'll go to the next one, which is on employee benefits. And Laurens already mentioned pension accounting, the famous pension accounting under the Dutch, well, in the Dutch environment, I would say. And of course, in this webinar, we need to cover employee benefits. So here we are. Pension accounting, yeah, that has traditionally been a topic of strong debate in the Netherlands. In the past, we have seen the DASB actually following the IFRS concept of defined benefit, defined contribution accounting. Probably you are all aware with that. But however, based on comment letters received back then, already 10 years ago or so, the DASB became convinced that the Dutch pension system in itself was and still is robust enough so that employers normally would see a limited risk for compensating any shortfalls in the pension funds. Well, I must admit that actually today you see an entire different situation, but at least that back then that was the way of looking at it, and basically that has been one of the main drivers for switching from the defined benefit, defined contribution accounting approach to the so-called liability approach for Dutch pension schemes on the Dutch GAAP nowadays. So, and what you then basically see is that contributions paid to the pension funds are expensed as the obligation to make that payments are incurred. But however, if an employer has an additional obligation to pay for further contributions, a liability for that obligation should be recognized on the balance sheet. And that liability is measured at the best estimate of the outflow of resources to settle the obligation. And all changes then are recognized in the income statement. For me, I think that the liability approach on the Dutch GAAP is basically very simple is very similar to IAS 37 under IFRS. But please be advised that IFRS requires post-employment benefits to be accounted for under IAS 19. And therefore, you need to assess whether you have a defined benefit scheme or defined contribution scheme. Finally, it's also good to mention that Dutch GAAP provides the option to consistently apply the full requirements of IAS 19 for the accounting of pension plans. And even more, it is also allowed to apply US GAAP pension accounting rules. But I think that's enough for employee benefits. And with that, I would like to hand over to Laurens again.
Yeah. Okay. So let's continue with the fun part. IFRS 9, financial instruments. Normally not for my clients, to be honest, as I'm working in corporates. So, yes, you all know, as from the 2018, IFRS 9 financial instruments became effective. As expected, we noticed that the new standard had more impact for financial service industry, like banks, and that the impact for corporates is relatively limited. But in general, we would like, to discuss with this slide 3 topics which are, I think, relevant to discuss and would impact your figures. At least you have to assess that. So the first is the expected credit loss model. So under the first 9, the bad debt allowances is now based on the expected credit loss model, but on the Dutch GAAP, it's still based on the previous IAS 39 incurred loss model. So you have to take a look at the day 1 loss expectation of your debtors, your receivables. Although in practice we know actually that the impact on the allowance of receivable did not change a lot. So from the incurred to the expected loss model, but this is our initial, findings based on the analysis of some listed companies, corporates. So the second one is loan modification, and this is a particular one. I think it's good to need your attention, especially when you have loans and the terms are modified over the years, because there's a change in IFRS 9 compared to IFRS 39. So when the terms of a financial liability are modified, and you have to think about interest rate different, or redemption scheme, or foreign currency denomination, that is modification. And the entity needs to consider whether that modification is substantial. If the modification is substantial, and that is the qualitative test, or you have to do the 10% quantitative test, when that is substantial, the original financial liability is then de-recognized, and new liability will be recognized at fair value. The process of assessing modification in IFRS 9 is similar to IFRS 39 and Dutch GAAP. However, in the IFRS 9, the treatment of the non-substantive modifications has become different. So if you do not pass the extinguishment test of the 10% of the qualitative test, that is a non-substantive modification, but the accounting has become different in the IFRS 9. So take that into account. As in the IFRS 39, changes normally did not result in the recognition of the original loan, and any transaction-related costs were included in a revised effective interest rate, whereas IFRS 9 requires that the gain or loss should be recognized at the time of non-substantial modification. So that gain or loss is equal to the difference between the present value of the cash flows in the original and modified terms, discounted at the original effective interest rate. I think it's good that for this item I refer to our insights into IFRS, which have really practical and good examples on loan modification. Another topic is hedge accounting. And hedge accounting has become a bit less strict on the IFRS 9. So the, let's say, bright line boundaries, the 80-25 percentage, that disappeared. And the full retrospective testing also disappeared. So hedge accounting, I think it can be applied, more and more relaxed way, and would help you really to have that hedge accounting available earlier. And the Dutch GAAP cost price hedge accounting model is also still available, didn't change. So what about the DASB? As you might know, they have made an announcement that Dutch GAAP reporters can apply the expected credit loss model for the calculation of impairment losses, besides remaining applying Dutch GAAP and having the incurred loss model. Sometimes, I will come back later, you are a dual reporter, reporting for IFRS for group reporting purposes and having local books based on Dutch GAAP. It might be helpful to try to align as much as possible these accounting policies. But note, this is a change in accounting policy if we would like to change that to the IFRS way of measurement of incurred losses model. Going to the next slide. IFRS 15. So like IFRS 9, IFRS 15 has become effective January 2018. And the first financial statements 2018 have been issued by corporates. We see in practice that the reported impact of IFRS 15 is diverse and really depends on the type of business and form of contracts, customers. We notice that most impacted industries are telecommunications, software, media, and client-specific production industry. For example, we have, I think, a very good publication on automotive supply guidance, which is client-specific production industry, which gives you good insights in the possible effects of IFRS 15. So currently we are investigating the top 75 listed companies in the Netherlands, and a publication called Annual Reports Market Watch IFRS 15-16. I think we will be issued early May, and we will also host a webinar on that topic. will be on 16 May. We will discuss then with you together the results of our examination. So IFRS 15 is replacing predecessors IAS 11, construction contracts, and IAS 18, revenue, which are still the standards which are available under Dutch GAAP, because Dutch GAAP there's 221 construction contracts and 270 revenue is actually more a copy of IAS 11 and IAS 18. IFRS 15, so that's a comprehensive standard, replacing 2 standards and some IFRS. But IFRS 15, the size, I think it tripled. So there's a lot of application guidance in it, more detailed guidance, also how to assess contracts based on the 5-step model, which you see here. So first, identify the contract with the customer. If there's no contract, then IFRS 15 is not applicable. You cannot recognize any revenue. So you have to take it step by step. My experience is that a lot of people assessing contracts would like to go directly to step 5, when to recognize revenue, over time or at a point in time, which of course is very important to assess that, because that's impact most of the time the accounting for the invested companies as well. But first, I would really, suggest do a thorough assessment, step by step, because there might be multiple performance obligations for which revenue should be determined separately, and revenue recognition should be, maybe at a point in time or over a point in time or at a different moment in time. And that moment in time does not always is at the same time where you're billing the clients. So that could be really changed. So Dutch GAAP did not change. However, Dutch GAAP allows you, go to the next slide, allows you to apply IFRS 15 as well. That's also a change in accounting policy. You have to apply, not cherry picking the rules, but you have to apply the full standard, including the transitional notes and the disclosure, transitional guidance and the disclosure notes. In all fairness, I think that when you're a large company doing Dutch GAAP as your accounting policy, and there is no detailed guidance available in Dutch GAAP, I think your auditor and yourself will also take a look at IFRS 15 and how IFRS 15 would deal with that aspect. Come to the next slide. So a timeline. So we just said that 9 and 15 are implemented, and the reports in 2018 are going published, and that 9 and 15 are incorporated in this figures, either applying different transition methods, fully retrospective, modified. But in the 2018 financial statements, also there should be an indication of the impact of IFRS 16 leases, which will become mandatory as from the 1st January 2019. So the impact on leases, so all the off-balance sheet commitments, when it's in scope of lease accounting, will result in a right of use assets on the debit side with the mirroring lease liability on the credit side. So in the financial statements 2018, it's part of a disclosure note under IAS 8. So it's not ready into the books, but as a disclosure note. Okay, Dutch GAAP is still based on the previous accounting of off-balance sheets for operating leases. IFRS 17, that's an insurance contracts, is our scope of this webinar, and is also still, I think, under construction. What's next? As mentioned before, in the form of financial statements, one of the ISB current project is regarding primary financial statements. This project is an early stage research, examining possible changes on the structure and the content of the primary financial statements. One of the focus items on the structure and the content of those financial statements is financial performance, including assessing whether it required a defined subtotal for operating profit to use alternative performance measures, like EBIT, EBITDA, which are not defined or specified in current IFRS standards. The ISB issued a staff paper in 2017, and the board will continue the discussions 2019. So I would ask you, to follow that closely, and to keep focus on developments, as there might be some interesting, developments on future reporting on alternative performance measurements. So we discussed this already a bit on lease accounting. If you see 3 columns, IAS 17 Dutch GAAP, similar, same accounting. For lessees, from off balance for operating leases, as under IFRS 16, there is no distinction made as a lessee for operating or finance lease. It all will become on balance and a similar accounting as finance lease. And it also impacts the P&L. For a lessor accounting, nothing changed. That remains the same. So looking at the time, I will go to the next slide. The Dutch GAAP also is allowing the application of IFRS 16, also in full. Transition guidance also available. Also a change in accounting policies. And like Fred said, on this possibility of IFRS, on a Dutch GAAP to allow IFRS 16, there has been some comment letters on consistency of applying those standards in the Dutch GAAP. So we go now to a poll question. And the poll question is for the ones who have been involved in a conversion, please state what went well during this conversion. So we talk a lot about standards, changing standards, and we give you some opportunities. And I see people are taking in their answers. Some project management, timely identification gaps. Yeah, and I close the poll. Yeah, go to the next poll, because we also would like to know what went wrong. Maybe it's the opposite. Yeah, I close. People are still giving answers. And I close this one. And I have a last question. How would you perceive an online environment for facilitating accounting conversion? So we talk a lot about the books, and the books are paper. So we're going for paperless conversions. I think that's a clear answer. Yeah. Yeah, and I close the poll now. I think so. Looking at the answer, there's a lot of need, I think, for technology improvement, innovations. I can say we are working on that currently with our new conversion tooling work, the innovation. That's I think the good news. If you look at what went well, what went wrong, we have quite diverse answers. and project management, timely in the communication with the auditor and also some others. So I think that is also what we are recognized in practice. We see a lot of, IFRS conversion or conversion to another standard is a complex item, which we should carefully also be planned and scheduled. So there are various reasons to change from a standard: expansion, better insights, cost savings, stakeholder requests, harmonization, but also future IPO. And that's really important to plan the conversion, not only in the year of expected IPO, but also, in an early stage. And you can start with a gap assessment. And when you're doing a gap assessment, this is really, I think, is an example, just a simple example of a project timing for tax accounting and reporting, that you plan the conversion well, because this is a simple one. It takes 8 weeks, but it can also take a couple of months when you are a big corporate, family company with a lot of offices around the world in several countries, which have to align all the accounting policies all places. So project management is really key in this. So what I would like to show is also that we have a lot of publication materials available. Of course, there's our jaarboek. It says 2017-18, which will be come a new one in, I think, a couple of weeks. And that will be also translated in English. That's the good news, I think, but that's later at the year end. We have it also available, apps. We have the IFRS app, the Dutch jaarboek, also an app available. Go to our website where you can find all kinds of publications on IFRS, on Dutch GAAP, but also it's good to contact your local KPMG, contact myself or Fred. Yeah, I think we have come to the end of the webinar. We hope you enjoy the webinar. It gives you insight, I think, in the historical perspective, but also in the future, what's happening into IFRS and the Dutch standard setting board as well. Gives you also a bit of insights how to convert with items, take in consideration in the planning phase. There are a lot of materials available. Sometimes it's really difficult and hard to get a clear understanding, how the conversion hits your company. So that's why I think it's good to have the contact with your KPMG and really address those questions and discuss it. Because the conversion is not only accounting and reporting, but it also affects your systems, your IT, the people who has to it, but also your contracts, KPIs, and other stakeholders would like to have that information as well. So feel free to contact me, Fred, or your other person. I would like to welcome you on 16 May when we present the results from an annual report, Market Watch, also in a webinar, and that publication will also become available. So thank you again, and I will close the webinar now. Thank you for joining, and enjoy the rest of the day.